Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to take a dive into certificates of deposit, both bank CDs, no penalty CDs, and what are called brokerage CDs. And we're even going to take a quick look at short-term U.S. government bonds. These are all, I think, reasonable options with their own sets of pros and cons for managing your cash. The question came up from a viewer named Terry. She wrote in, she said, I'd like to move some money to a CD. By the way, in Terry's case, she's in retirement and they're trying to bridge the gap between where they are now and receiving Social Security in a few years. And so they're going to use certificates of deposit to help them do that. She says, I don't understand the difference in buying a CD through my brokerage, in her case, Fidelity, which is showing products with high rates, or buying directly through a bank like SallieMae Save Better, listed in your newsletter. I'll talk about that in a minute. I feel confident in Fidelity, and I'm not sure about an online bank I've not done business with. Can I trust them? Could you share your thoughts? What should I watch out for? Well, Terry, that is a great question. Now, she mentioned Save Better in my newsletter. First of all, I do send out a newsletter every Sunday. You can subscribe to it. There's a link below this video. I basically read about 100 articles a week and curate that and pick 5 or 6 typically to put into the newsletter. People seem to enjoy it and get a lot out of it. I have a lot of fun putting it together. Again, you can subscribe to the newsletter below this video. Now, the last few weeks, I've been sort of tracking interest rates. I do have a site, allcards.com. One of my goals of the site is to track all interest rates when it comes to savings accounts, money markets, checking accounts, CDs. As you might imagine, that's some undertaking. It's still a work in progress. So one of the best deals I have found for no penalty CDs is through a company called Save Better. They are an advertising partner of the show, which is frankly how I found out about them. They reached out to me. And I have found their no penalty CD to have at least the best rate I can find for a no penalty CD. We'll look at it in a second. Please, if you know of better rates, please email me. They will absolutely go up on the page. I'll mention them in the newsletter. My goal here is to find the best rates I can and share those with you, whether they're an advertising partner or not. And frankly, in some cases, Save Better doesn't have the best rates, but with their no penalty CD, pretty darn good from what I can tell. So enough chit chat, let's get to it. I want to start with a traditional bank CD. This is at the Save Better site. The way Save Better works, by the way, you create an account with Save Better, which I've done, and then you can invest in any of their bank products. You don't have to go and open up separate accounts at each of these banks, and they're all FDIC insured. With just your standard fixed term CD, let's just take a look at this first one. It comes from Patriot Bank. It's a 13-month high yield CD paying 2.75%. The thing to know with most bank CDs, there is a penalty if you cash out the money early. So in this case, if you decide to take out your money before the 13 months are up, you pay a penalty. We can look at the product terms here, and it opens up this page, and we can see what they are. I've highlighted it. Since this is a 13-month CD, it would fall into this category here. If you take your money out early, the penalty, 270 days worth of simple interest, which, given that it's a 13-month CD, that's a lot. That's significant in my view. So I would not consider this certificate of deposit unless I was, pretty darn sure I wasn't going to have to take the money out early. Now, that brings me to no penalty CDs. The one that I talked about recently is this one in the middle. It's a SallieMae Bank, probably familiar with it. Again, these are all FDIC insured. For 14-month no penalty CD, it's 2.5%. And again, as the name suggests, you have to wait 7 days. But after that, you can take the money out. You'll get your money back. You'll get any accrued interest, and you won't pay a penalty. And so in this case, that kind of product was ideal for me. Now, I ended up choosing the Patriot Bank 17-month no penalty CD. It pays a little bit more, and the term is a little longer. And you might say, well, Rob, since these are no penalty, what difference does the term make? Well, the term will be important if interest rates fall. If interest rates end up going down, right now that may be hard to imagine, but if they do, I could keep my money in there for a little bit longer and earn that higher interest rate. However, the benefit of a no penalty CD is, what if interest rates go up? Let's say in a month or two, the Fed raises its rate and this 255 goes to 285. Well, I can sell this CD, I get all of my money back plus accrued interest, and then I can turn around and put it back into that higher paying CD. That's one benefit. The other benefit in my case is I may need the money before the 17 months is up. I probably will. This money is for some work we're going to have done on our kitchen. And I have the benefit of being able to take the money out and not have a penalty. Now, with everything in life, there's no free lunch, right? There are pros and cons. So one of the downsides of this is you could think of this no penalty as an insurance policy in a way, and you're paying for it. How are you paying for it? You're paying for it with slightly lower yields. And that gets me to Terry's question, what about brokered CDs? Let me show you an example and we'll walk through how they work. And since she mentioned Fidelity, that's what we're going to look at. So let me show you that now. This is the Fidelity website. And I'm actually logged in. To see this, you have to be able to log in, but I'll say that you can buy brokered CDs, I guess from just about any brokerage. I know Vanguard sells them. I'm confident Schwab does. And I want to focus on the 1-year CD, basically because if we come back here, we were looking at these fixed terms, 13-month, the no penalty, 14, I guess this goes 17, but it's close enough. And you'll notice that for a brokered CD, you can actually get a better rate, 305. Now, we have to understand how brokered CDs work. In the case of Fidelity, they will go to a bank and they will buy in large denominations. They will invest money into certificates of deposit directly with, in this case, FDIC insured banks. They then break those up and sell them to their customers. So you're not actually investing the money directly into the bank. You're investing it through Fidelity, buying it from Fidelity, but you do get the FDIC insured protection, at least up to the limits. The other thing about a brokered CD, though, that's different, let's say you want your money out early. You wouldn't go to the bank and ask for your money back because you didn't buy this CD from a bank. You bought it from, in this case, Fidelity, but you could sell it on the secondary market through Fidelity where someone else would effectively buy your CD from you. Now, that's a good thing. That's an advantage to a brokered CD, but you do have to understand this. If interest rates have gone up, so you're buying, let's say, a CD at 305. Let's say 6 months from now, you want to sell this 1-year CD, and the prevailing rate then is 3.50. Well, rates have gone up, so to sell it, it's no different than a bond. You're going to have to sell at a discount. So there is, or can be, a quote. I'll put the penalty in air quotes. There can be a penalty for selling a brokered CD if rates have gone up, just the same with bonds. Now, of course, maybe the opposite happens. Maybe rates go down. You can sell at a premium. But you need to understand that, again, no free lunch, right? There are advantages and disadvantages with all of these options. With a no penalty CD, you get all your money back, but you're starting with a lower yield. With a brokered CD, if you need your money early and rates have gone up, assuming there's a market for that CD, there's no guarantee that there'll be a market for it. I do think Fidelity tries to create a market for their CDs, but no guarantee. But assuming there is, if rates have gone up, you're going to sell at a discount. You're not going to get the full amount of money that you invested in that CD back. On the other hand, if interest rates have gone down, you sell at a premium. So in that sense, brokered CDs behave similar to bonds. So if we dive into one of these, we'll look at the 1 year. You can see that they have a number of different options. And you can see that we were looking at 305. There's actually one that yields 310, but you have to look at call protection. That's another thing to understand. This is not call protected. Just like bonds, some CDs are callable. What that means is under certain conditions, the bank can say, you know what, the term isn't up yet, but we're going to give you your money back. We don't want to keep paying you the interest we're paying you. Here's your investment back along with any accrued interest. Why would a bank do that? Well, they might do that if interest rates have fallen, right? They're in a sense paying more for your money than they need to. So they'll say, here's your money back, and we're going to go issue new CDs at lower rates. Most of the CDs here are call protected, as you can see, which is, in my case, what I would generally focus on. You do get a little bit of a higher yield if they're callable, but that just adds more complexity to the transaction that for me is just not worth it, but it may be for you. So for CDs that aren't callable, you can see the top rate is 305. There's actually only one left for that one, but we've got more here from this bank, and then they go down in yield as we move down. And so you can work through whatever brokerage you use and buy the CDs that make the most sense to you. I do think by and large, brokered CDs like at Fidelity, you're going to find the absolute, or if not the absolute, very top best rate. If we were going to go directly with a bank, one of the best that I have found, and I'm going to show it to you now. What are they paying? Yeah, they're paying 305 as well. It's CFG Bank for certificates of deposit. So for their 12-month, if you can see that, I can make it maybe a little bigger for you, is 305. So the same that we saw over here with Fidelity. Now, one of the points that Terry made is that she's got an account at Fidelity. She's comfortable with Fidelity. It would keep all her money in one place. Is that worth considering over, say, going with CFG, for example, or maybe with Save Better if you like their no penalty? I think it's absolutely worth considering. If you keep your money, you've got a brokerage account already, you're going to have your money in one place, you're comfortable with Fidelity, I absolutely think that is something worth considering. In my case, what I did was I opened up this no penalty CD through Save Better. I was comfortable with that. Patriot Bank is FDIC insured. The amount I invested does not exceed that limit. But I'm also considering investing some cash through Fidelity. Now, in my case, I probably won't go with the CDs. Instead, I'm thinking about a short-term government bond. And on this page here, we can see the yields. So this is, again, the CDs. We saw them, 305 was what we were looking at for the 1 year. U.S. Treasury is slightly more for 1 year, 307. The thing I like about U.S. Treasuries is that they're not subject to state and local income tax. Now, depending on your circumstances, where you live, that may or may not be important. In our case, I think we pay 5.75% state income tax. I'll save that on the interest that we earn from from a U.S. Government bond, U.S. Treasuries. I'll pay that on a certificate of deposit. Is it huge? No, but look, when you're dealing with low yields to begin with, that's an advantage. But just like brokered CDs, we have to remember, if I buy a Treasury 1 year, for example, and interest rates go up, the value of my bond is going to go down. Now, it's a 1 year bond, just like a 1 year CD. It's not a huge interest rate risk, but it's something to consider and factor into your decisions. Now, let me show you how the Treasuries work here. If we were to look at these, you'll notice a couple of things that I want to walk through briefly. The coupon, that's the interest the U.S. government is going to pay. You'll notice that some say 0. Boy, that doesn't seem like a very good deal. And then some have, look, 1.125. This is 1.375. Look at this one, 2.75. Shouldn't I just go with that? What's the deal here? Well, you have to remember that we're looking at 1 year treasuries. So they're going to have a maturity date. You see that here in July. Generally, some of them are a little shorter. This is June 30th of next year. All right. The ones that have no coupon are actually treasury bills. And here's an example of one. United States, you can see it, treasury bill, 0 coupon. The way these work, they don't have a coupon interest rate. Instead, you buy them at a discount. And then when they mature, in this case, in July of next year, you'll get the full face value. So we're buying them, let's say it's somewhere around $97. And when they mature a year from now, we'll get $100 back. And when you do the math, that gets you the yield. And you see there's a bid, what people are willing to pay, and an ask, what's the selling price. The spread's not that much different. You can see it here. But we'll use this yield to maturity for the ask price. That's where we get the 3.07 that we saw in the page before, and that's how the math works out. For these that pay a coupon, These started out as U.S. government bonds with maturities of longer than a year. So we can let's look at this one right here. This was issued all the way back in 2018, but it matures, let's see here, July 31st, 2023. So if we bought it today, it's effectively a one-year bond. And if we go back, here it is. This is what we're paying, but when you do the math, the yield comes out to 305, just about. So those are things to understand. It seems, I don't know, at one level may be complicated. I don't think it really is. But you can buy or sell them, right? And there's obviously a secondary market. Now, I want to jump back to, we're going to go back to fixed income. One last thing I want to show you. We're going to go back to CDs. We were looking at these brokered CDs here. These are all new issues, right? Well, here's secondary market for CDs. And if we look at that, and let's look at maturity dates, see if I can, we'll do August of next year. And I think I don't have to put them both in. We'll do it anyway. Is that limited? Okay. It's very similar to what we were just looking at for U.S. Treasuries. Here's the coupon rate over here, and you can see they vary widely. Here's the maturity date, the bid and the ask, and you get down to the yield. These are all 1 year, so they're all around 3%. Here's one that's 3%. So, although this one has a call, right? So that one's callable. So there are a number of factors to look at when you go into the secondary market, whether it's for brokered CDs or U.S. Treasuries. It does take a little bit more work, a few more things to understand, but I think it can be worth the effort depending on your goals. So at the end of the day, what do we have? Well, we've got no penalty CDs. They're FDIC insured. You can take the money out after 7 days. Anytime you want after that. You won't pay a penalty. You'll get your full investment back plus any accrued interest. You can then spend the money, or if rates have gone up and you want to take it and invest it in a higher paying CD or other type of investment, you can do that. With a brokered CD, you're buying them typically, through a brokerage like Fidelity. You can buy either new issue or you can buy it on the secondary market. If you buy the new issue, you hold it to maturity, you know the rate you're going to get or the yield you're going to get at the time you purchase it. If you do decide to sell before then, you could sell at a premium or a discount depending on what interest rates have done. So there is what they would call interest rate risk that you need to factor in. And if we go over to U.S. Treasury, short-term treasuries, no state and local income tax, I think that's a big benefit. But just like brokered CDs, there is some interest rate risk. If you're buying CDs that mature in a year or less, is the risk significant? No, but it is there, and it could turn out to be a better deal or a worse deal than, say, a no penalty CD. It just depends what interest rates do over the next year, and I'm generally not one to try to guess. So in my case, what am I doing? Again, this may not be best for you. As I mentioned, I put money into the 17-month no penalty CD at Patriot Bank through Save Better. It earns 2.55%. I did that a few days ago. I'll leave a link to that particular no penalty CD in the video below. But if you know of better paying no penalty CDs, please let me know. I will add them to my list and let folks know in the newsletter as well. But I'm also buying some short-term U.S. Treasuries. I like the fact that there's no state and local income tax. The yields, I'll call them good relative to other options we have. So I am putting some of our kitchen remodel money into short-term U.S. Treasuries. So there you go. Terry, I hope that answered your question. I kind of feel like I've thrown a lot of details at you, but hopefully it helps. Again, I don't think there's a right or wrong answer. It depends on your personal goals, your personal comfort level. And again, it's not one or the other. You might pick 2 or more of these strategies to invest your cash. Listen, if you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.